Are you new to investing and wondering which ETFs you should buy in 2026? There are thousands of ETFs available. Some are risky, some are overly complex, and some are simply not designed for beginners. So today, I'm going to break this down in a very simple way. I'll show you 3 ETFs that can form the foundation of a smart, balanced, beginner-friendly portfolio in 2026. These 3 cover stability, income, and growth. Let's start with the first one. The first ETF every beginner should consider is a broad market index ETF. This type of ETF tracks the overall stock market. That means instead of buying one company, you're investing in hundreds, sometimes even thousands of companies at once. That's called diversification, and diversification is one of the most important principles in investing. When one company goes down, another might go up. When one sector struggles, another might grow. This reduces risk dramatically compared to picking individual stocks. Historically, broad market ETFs have delivered steady long-term growth. They won't make you rich overnight, but they are reliable. For a beginner, this is the foundation. It's stable, it's simple, and it works. Now let's move to the second ETF. The second ETF to consider is a dividend ETF. Dividend ETFs invest in companies that pay regular cash dividends to shareholders. This means you're not only relying on price growth, you're also receiving income. And here's where it becomes powerful. If you reinvest those dividends, you activate compound growth. Your dividends buy more shares. Those shares produce more dividends, and over time, that snowball effect becomes significant. Dividend ETFs are generally less volatile than pure growth funds. That makes them attractive for beginners who want both stability and passive income. You get paid while you hold the investment. That's a powerful psychological advantage, especially when markets are volatile. Now let's talk about the third ETF. The third ETF is a technology-focused ETF. Technology drives innovation. Artificial intelligence, cloud computing, cybersecurity, automation, these industries are shaping the future. A tech ETF gives you exposure to high-growth companies without the risk of betting everything on one stock. Yes, technology can be more volatile, but when combined with a broad market ETF and a dividend ETF, it adds growth potential to your portfolio without making it reckless. Think of it like this: broad market ETF for stability, dividend ETF for income, technology ETF for growth. Together, they create balance, and balance is what beginners need. You don't need 15 different ETFs. You don't need complicated strategies. You don't need to trade every week. You need simplicity, consistency, and long-term thinking. Start small. Invest regularly. Diversify intelligently, and give your money time to grow. If you build your portfolio around these 3 ETF categories, you're already ahead of most beginners in 2026. Have you invested in any of these types of ETFs yet? Let me know in the comments. And if you want more simple, beginner-friendly investing strategies, make sure to subscribe.